Hi, Jim Gore from Thor Wealth Management. There's something happening in the market that is very interesting right now, and it's not the stock market, it's actually a bond market. But before I explain what is happening, I have to give a little bit background about what we're talking about. And what we're talking about is the yield curve. Now, the yield curve is an instrument that shows you what the yields are for certain maturities of treasuries. So you look at the vertical axis, that's your rate of return or interest rate that you're receiving. The horizontal axis is your maturities. Go on the left-hand side from the 1 year maturities all the way out to 30 years. And usually you have a normalized yield curve, which is a steepening yield curve, where longer term interest rates are higher than short term interest rates. That's normal and that's good for the economy. The reason why that's good for economy is because companies and lending institutions will lend out longer term their money if they're getting paid a higher rate of interest. In the case of what is known as a inverted yield curve, or sometimes a flat yield curve, in an inverted yield curve, you have short-term interest rates are higher than long-term interest rates. In a flat one, you have short-term interest rates are the same as long-term interest rates. In that environment, that is actually bad for the economy and showing that there's distress in the economy. And the reason for that is lending institutions will not lend out longer term if they're getting paid the same amount for short-term money. And usually that inverted yield curve occurs when the Federal Reserve raises interest rates on a short-term basis and you see those rates go up. However, sometimes it happens in the economy and in the markets, and we saw that with COVID-19. We actually saw people running to longer-term bonds, and we saw the yield curve flatten back in March and April. Well, what has happened in the last couple of weeks is very, very interesting. Right before the election, we actually started seeing the yield curve steepen, which we saw longer term interest rates starting to go up when short term interest rates are virtually zero. And then right after the election, the day after the election, we saw those interest rates come down right away. We saw a flattening. And the reason for that was because of the election. There were two things. One is that some people thought that we were going to have more restrictions put on a new administration with COVID, which is going to dampen the economy. And the second point was that we might not get as big a stimulus because the Republicans would be in charge of the Senate, and that's going to dampen the economy. Well, lo and behold, all of a sudden Monday, we get the vaccine from Pfizer, and right away we saw interest rates on a long-term basis go up. So we started seeing it get steep out there. Which is good for the economy. That's what you want to see. That means the economy is going to improve. And the expectations are with this virus that things will get back to normal. People will start spending money and traveling, and that is good for the economy. And that's why you start seeing the steepening yield curve. This is something to watch very closely. And it's even more important to manage your money, especially on the fixed income side, for events like this that could impact your portfolio on the fixed income side, either on a negative basis or on a positive basis.